And of course, they've got absolutely killed. So there is no speculative money in COMEX at the moment. And because COMEX is a pretty good reflection of what's going on in London in terms of sentiment, if you like, then I think the same situation is in London. And this is against a background where all the major banks are now saying we expect gold to go to $6,000 or whatever by the end of this year. So in other words, the banks are looking to buy. And I think that is part of the explanation as to what has happened. Shake the trees, try and get the price down, then we can buy some. And I'm convinced that was a lot of the logic that we've seen in both gold and silver. Well, it doesn't surprise me. It certainly drove silver lower in Shanghai overnight. And Western capital markets have sort of continued its discount compared with the Shanghai price to the order of about 10-12%. So it doesn't surprise me that that's being cited as a reason. I think it's probably fair, but on the other hand, it doesn't really explain why gold has been easier today as well. I mean, that was hit quite hard at one stage. Yeah, I mean, the only thing I would say is that if this chap has gone short, then he's got to buy it back. And then what price? There's no physical around at all. I mean, meaningfully, I mean, the only thing you can do is rush out, buy futures and stand for delivery, or go into London and buy a forward contract and insist on delivery. There isn't any meaningful quantities of silver around. So if you get someone chucking out billions in paper, I mean, it's just going to lead to a squeeze later, because there is not. I mean, if you're going to go short of something like that, then it only works if there are an awful lot of people long and you can shake the trees and get these punters out and force them to close. That's the only way in which a short really works. I mean, unless you're talking about investing in a company which goes bust. You got some inside information. That's not what we're talking about. We're talking about a situation that requires people on the other side of the transaction to sell after you so that you can retrieve your position. And if you're going to go and sell a huge quantity of futures or sell forward, huge amounts, whatever, then in the absence of that cover, you're going to get squeezed on the way out. And this chap, apparently he made a fortune or something in gold. I must admit, I haven't really got to grips with the story, but
he made about $3 billion in betting long on gold since 2022.
Well done him. Yeah. I mean, if he's gone and shorted silver, I think what I would say is that his long position in gold was either on the back of information from, let us say, the highest contacts in government in China. There's no doubt that China has been a major force in driving the value of gold. Or alternatively, he just got lucky. It happens. It does happen. But you know what trading is like? You trade, you think, oh, God, aren't I clever? I've made a fortune, done very well. I can't lose. I know what I'm doing. So you go and make another bet, and then what happens? You get killed. That's the way trading works for most of us anyway. So I'm not impressed. And I would say that, what I do know is that the people who are trying to stack silver in size, there's none available. And you go to the refineries and they say, sorry, we haven't got any, we're too busy doing gold. If you want gold, go and join the queue. You could probably get some gold, but silver, forget it. That's just, there's none, full stop.
Yeah, and silver is currently trading at $75 spot. Good luck trying to get $75 spot anywhere. Trying to find $75 spot at any dealership or from anyone at this point. Yeah. So you're going to be looking at premiums, massive premiums.
Yeah. It's fascinating. If you look at the open interest on COMEX in silver, it's pretty low, which confirms that the punters are just not in it, And I think this shakeout that we've had really from the end of the February contract really the consequence is that there is a platform, I think, for the silver price to go considerably higher than it might have done otherwise on this run. It looks good to me. But of course, you've got to have a bit of nerve because it's quite volatile. But there we are. This is why I always tell people, for goodness sake, don't try and double guess it, because there are people in there far larger than you who will whipsaw you. Thing to do is just stack. Don't worry. Just stack and don't worry. And I mean, you could have been stacking silver for years, but eventually the whole thing came right. And it looks to me as if it'll continue to come right, because assuming gold goes higher, and that's another story which I'm sure we will talk about, then silver, I think, has got a long way to go.
Short selling only works when sellers can force others to liquidate. In markets with abundant supply, that's possible. In silver, it's increasingly dangerous. Physical availability is thin, and large holders know it. When oversized short positions enter a market with limited real metal, exit becomes the real challenge. Without forced sellers on the other side, shorts eventually face pressure to cover at higher prices. This dynamic creates the conditions for a squeeze. History shows that betting against a scarce monetary metal often ends not with control, but with capitulation.
And, we know that China has been moving to use gold, if you like, as part of international trade settlement. And, the obvious way in which they do this would be to make the yuan, international yuan, exchangeable for gold. But the question then arises, what are they going to do in the domestic market? Now, fortunately for China, and also India, incidentally, both those nations have exchange controls. So they can actually come up with a different answer for the domestic market, domestic yuan, with the international. Now, my assumption is that central banks are extremely jealous of their gold reserves. They want to hold on to them. So they don't want their people, the great unwashed, taking gold out of the central bank, which, I've got an argument which says that they should actually just go on a gold standard full stop. But I don't think that's the way they're thinking. But I do think that they could easily, with the gold they've got and the silver they've got, I'm talking about China rather than India now, they could easily, at some stage, fix a relationship between gold and silver so that the domestic yuan is on the silver standard while the international yuan is on the gold standard. Now, if that's the case, you've got to ask yourself, well, first of all, what price is gold going to be? Well, say in dollars rather than yuan, to get a rough idea. And the second question is, what is the ratio going to be that the Chinese will fix it? And I think whichever way you look at it, you come up with a far, far higher price for silver. And I think the other thing, Danny, is that, bear in mind that there's something like a 30% savings rate in household savings rate in China. And that's throwing out, $5-6 trillion equivalent going into investment, and property market, dead. Stock market, well, it's been sort of reasonable, I suppose, but it's not everybody's flavor. So what's happened is that the majority of these savings have just gone into deposit accounts, which the banks have been quite constructive in terms of, let's, instead of paying you very little for 1 year, why don't we make it 3 years and we can up the interest rates or thing. But the People's Bank of China has been cutting interest rates. And the major banks, what do? They offer a gold accumulation account alongside your deposit account. So savers can go and literally just put in 500 yuan a month, if you like, or a lesser amount, into a gold accumulation account. And we're talking about, in a year, we're talking about a portion, and a goodly portion, of about $5 trillion. So, the other aspect of this is I think that when it comes to actually, a Chinese individual actually going and buying gold as opposed to running a gold accumulation account, they probably look at gold and think, well, gold is I haven't worked out what the price is in yuan, but let's say it's $5,000 or whatever. But silver, on the other hand, is $100. I can afford silver a lot more than I can afford gold. It's so here again, you can see that Chinese individuals and also Indian individuals are going to go, and I think already are going for silver in quite a big way. The point about it is that in Asia, silver has more recently been physical money in everybody's experience. Whereas in America and in Europe, we see it as small change. It's no more than small change for us. But in Asia, where Maria Theresa dollars have been circulating in the Middle East, I mean, I remember seeing them back in the 70s when I was in the Middle East. And then if you go to China, they were on the silver standard until 1935. And India, they collect silver as, they hoard silver just the same as they hoard gold. And if they can't afford gold, they hoard silver. So you can see that silver demand in Asia is really going off the charts. There is no liquidity in it anywhere. And don't be confused by stories. I mean, I saw stories, was it last week, about how dealers in America, sort of find that they're getting people coming in with scrap coins and scrap silver, whatever, and they don't want to touch it. I can understand why, because the thing's so volatile. You buy, say when silver's 120, and the next thing you find is that it's 75. Who wants to deal that? That is not what you want to do. And also the other thing is that if you do buy silver and you hedge it, your hedges have gone wrong. So of course nobody wants to deal in it in the West because it's just too risky. It's not a statement that silver is too high or too low. It's just that because of its volatility, it is too risky.
Away from future screens, the physical silver market is sending a very different signal. Refiners are booked, dealers report limited availability, and premiums have detached from headline spot prices. Open interest on major exchanges has fallen sharply, indicating speculative traders have stepped aside. That matters because low participation after a sell-off often creates a stronger foundation for the next advance. When few are leveraged and inventories are tight, price moves tend to reflect real demand. In other words, silver may be calmer beneath the surface than the charts suggest.
Well, I think that the United States has got itself into a bit of a problem here because it's suddenly woken up to the fact that it has no control over rare earths and important critical minerals like silver. I saw on X, I don't know if this is true, but Vance is calling a meeting of 50 nations to try and set a floor on the price of critical minerals. I mean, it didn't make much sense to me, quite frankly. I mean, you set a floor on the price. I mean, you said, what do? You say it's bid only here. I mean, it's just complete nonsense. The report was nonsense. I don't know what Vance was actually doing, if he was doing anything. But there's no doubt about it. We're talking about a problem which America, I'm sure, is considering how to fix it. But it's going to take time. I mean, you can't suddenly set up a refinery for stuff in volume. It is going to take time. So, but what we're talking about is a squeeze in the market, which is now. And we're talking about the demise of the paper currency system, as the means of controlling the value of physical. That, I think, is coming to an end. And if I'm right in that, then you're talking about at most a year, probably months, before the sort of derivative situation, if you like, suddenly either implodes or goes away. Open interest goes down towards zero, whatever, however you like to put it. But I mean, we've lost control of the prices here completely. And using futures and forwards as a means of controlling prices, that's yesterday's story now. Price control for silver is actually in China's hands now. And they seem to be quite happy to see the price rise. It would be quite easy for China to turn around and say, right, we're going to stuff some silver into the SGE vaults and make it all look nice, tickety-boo, take the steam out of it and all the rest of it. They show no signs of doing it, which I think gives us a message as well. It raises the question, what is China's official policy on silver? We know that they came in with new regulations, export controls. They allowed something like 40 organizations to export silver, but basically behind that, there is, if you like, the intent to have a firmer control over the export of silver from China. All this is designed, I think, to put the squeeze on someone, us, I don't know, America, President Trump. They have it within their power, actually, to flood the market with silver, but they're not doing it.
In much of Asia, silver is not a curiosity. It's remembered as money. China and India both have deep cultural ties to silver ownership, especially when gold becomes unaffordable for everyday savers. Rising household savings in Asia are increasingly funneled into precious metals, either directly or through accumulation programs offered by banks. Silver's lower unit price makes it accessible to millions. This steady, grassroots demand is difficult to track but powerful over time. Unlike speculative flows, it doesn't vanish during volatility. It quietly absorbs supply.
I think they recognize that there is a big change. And, this is what's led me to speculate that they will probably, they're probably considering putting the domestic yuan onto a silver standard, because after all, that's where it was. Last time there was a metallic standard. And they've got the means to do it. But what they've got to see, I think, is not just the yuan gold exchange rate rise measured in yuan, but they will also need to see the exchange rate between gold and silver rise to the point where it becomes practicable. So, I don't know. I mean, if I'm right about that, and I've got no evidence that I am right, I'm just purely speculating, then China would probably, sort of reckon that the gold-silver ratio should be in the region of 15. That's where it was before.
15.
I don't know. And you see, you've also got the same situation in India. India is actually short of gold. I'm talking about the state, the government. The people are not, obviously. But again, a silver standard would work there. And I think that's something which the Indian government could probably get silver more than they can get gold. I don't know. I mean, they could well follow China in that. It would make some sense, I suppose. Anyway, it's speculation, as I say, entirely speculation. But I think it could explain why China isn't intervening in the silver market. It always has in the past. It's stopped intervening, basically. Well, I would say that you could argue that a higher silver price would not disadvantage a photovoltaic and electric vehicle manufacturer, simply because China is a better user, if you like, of overall manufacturing resources than anywhere else. I mean, if anyone's going to find it very difficult to make photovoltaic cells with a high silver price, it won't be China. I mean, okay, it means that the price of photovoltaic cells will rise, but because China is a far better manufacturer than anywhere else. It's got the technologies, it's got the scale, it's got the automation, it's got, beat that, mate, I think is the sort of message. And so in that sense, I think the silver price is immaterial. And we're talking about two activities, PVs and also EVs, which, are pretty inflexible economic-wise. I mean, if you get a downturn in the global economy, there's still going to be a huge demand for particularly photovoltaics. And China's virtually, sweeping the market with electric vehicles.
Western exchanges rely heavily on futures and forwards to manage prices. But that system only works when confidence in paper settlement remains intact. As open interest declines and physical metal tightens, the influence of derivatives weakens. Recent violent moves suggest that control is slipping. When large players attempt to push prices lower without real metal backing them, markets can overshoot in both directions. Increasingly, pricing power appears to be shifting toward regions with physical dominance. That transition is uncomfortable, but historically, it precedes major repricing events.
Well, I think you have to look at it in the context of the timing of it. By Friday evening, in China's time, if you like, everybody had gone home. They had actually started closing a few positions ahead of the weekend, which any speculator is sensible to do. That then left the market, if you like, in the hands of London and also COMEX. And basically, once they managed to start shifting the price downwards, there were no buyers. It was an offered-only market. So you had a vacuum under the price, and they could push it to anywhere they wanted. And all this was facilitated by China's absence over the week, with their weekend starting early, and at the same time, the end of the February contract. So that was the basis of it. And that's why it was so violent. I mean, something which we'd normally expect to take a month or two just literally happened in a day. And of course, it sort of discombobulates everybody so that on Monday, you don't know what the hell's going to happen. It sort of went up, went down, we saw a new low and people were sort of holding their, the traders were sort of worried. But I mean, the fact is that traders are not in there. Just look at the open interest. And the open interest in gold has just completely collapsed. It's just over 400,000 contracts now. That by any definition is oversold. And the interesting thing is, if you looked at the commitment of traders figures between, I think it was the 2nd of December sort of, if you like, a couple of weeks ago, the position of the managed money, which, the speculative hedge funds, their long position had actually plummeted, even though open interest was beginning to rise. And it was only in the last few weeks of January that they started buying into it, but not in any great quantity. And of course, they've got absolutely killed. So there is no speculative money in COMEX at the moment. And because COMEX is a pretty good reflection of what's going on in London in terms of sentiment, if you like, then I think the same situation is in London. And this is against a background where all the major banks are now saying, we expect gold to go to $6,000 or whatever by the end of this year. So in other words, the banks are looking to buy. And I think that is part of the explanation as to what has happened. Shake the trees, try and get the price down, then we can buy some. And I'm convinced that was a lot of the logic that we've seen in both gold and silver, is that nothing has changed. The fundamental situation for the currency, for the dollar, is looking as bad as it ever did, and it is deteriorating. And the measure of that, at the end of the day, is the price of gold. And people getting out of dollars to get into base metals, silver, platinum, copper, whatever. We're seeing that. That is a trend which has now started very, very definitely. So this shakeout, it doesn't change anything at all. And I think the people who will come through this are basically stackers who just take, if you like, a stoical view of the whole thing. Traders might make one trade and do well, like our Chinese billionaire, but my God, sooner or later they'll lose the lot. And they won't be in when it really matters, which is probably the most important thing.
Short-term trading in silver has become a high-risk endeavor. Rapid swings punish leverage and reward timing few can master consistently. Long-term holders, however, face a different equation. Scarcity, monetary uncertainty, and rising industrial demand remain intact. Shakeouts remove weak positioning, but do not alter structural trends. As currencies weaken and metals regain monetary relevance, silver's role grows, not shrinks. Those who view volatility as noise rather than signal tend to endure, and when repricing finally settles, it rarely rewards those who exited too early.